I think the curve right now is telling you that it's okay for the Fed to cut one or two times. Like we're inverted from overnight rates to 2 year. And so we probably could have two cuts and the bond market would be fine with that, right? That's what the curve's telling you the Fed should be doing. I think, I actually think I agree with that. I think the Fed should cut. Um, we're seeing some slowness in consumer spending. Like if you look at the visitor data in Las Vegas is a leading indicator, right? I mean,
Right.
consumers just aren't spending, right? And then also the housing market's been on its butt for 3 years. And so we really could use some rate cuts there's certain interest rate sensitive parts of the economy that are really struggling. So we could use some rate cuts. I would say generally that's helpful for my investment thesis. Like I think, small mid cap regional banks are undervalued and they would benefit from a steeper yield curve. And when I think about where in the curve I look at it's overnight to 5 years. Like right now, that's zero. Like it's flat. Overnight to 5 years is flat. So if we got 50 or 100 basis points between overnight and 5 years, that's hugely beneficial to regional banks. I mean, regional banks are trading cheap to where they trade historically. Like they're, 8, 9 times next year's earnings, where normally they're 11 or 12 times next year's earnings. So, that I think part of that's the headwind that they have from the flat yield curve.